Good morning. My name is Miguel Gonzalez, and I'm a certified retirement counselor with over 20 years of experience helping clients in retirement income planning, overseeing investment of funds, and designing retirement plans. Let's talk about making your own investment luck this St. Patrick's Day. As Samuel Goodwin once said, the harder I work, the luckier I get. But when it comes to investing, luck may play a huge role in outcomes, no matter how hard you work. Below, we discuss some ways that luck may impact your investing, as well as some steps you may wish to take to try to make your own luck this St. Patrick's Day. The impact of luck on investment returns. One reason so many financial professionals advise against market timing for long-term investors involves the distribution of days with major gains and days with major losses. Historically, and particularly seen during the earliest days of the COVID-19 pandemic, some of the market's best days were followed by some of its worst, and vice versa. Trying to sell at the top and buy at the bottom may require a great deal of luck. You may need to trust that a day with a 2 or 3% loss may not be immediately followed by a day with a 2 or 3% gain. However, over the course of a long investing horizon, these single-digit gains and dips are not likely to have a major impact unless you make a habit of buying and selling during volatile periods. You want to focus on the process, not on prior results. How can you take advantage of good luck and avoid the impact of bad luck when choosing your investments? The answer may be complicated and may depend on your personal circumstances. However, by focusing on the investment process rather than chasing returns by buying into the funds that recently had a good run, you may be more likely to pick a future winner. Having a solid process may increase your probability of investment success over time. With your financial professional, consider focusing on these 3 steps. Number 1, discuss your financial professional's analytical process. How does your financial professional choose funds? Does he or she know whether it's time to dump underperforming funds or stick around for a future rally? By having some insight into the process your financial professional uses to choose their investments, you may determine whether this approach fits your risk tolerance and desired asset allocation. Number 2, ask whether this process is designed to manage or mitigate some of the behavioral biases that may send investments off course. Some of these biases include overconfidence, sunk cost fallacy, and anchoring of sources. Ensure that your financial professional is reading and absorbing information from a variety of solid sources. And number 3, once an investment or set of investments have been chosen, evaluate it with an eye toward its end user. Is this investment intended to provide high commissions that enrich the investment company more than the shareholders? Or does it provide an excess return that more than accounts for its fees? Compare the investments to their benchmarks to see how they've performed over the years. And sifting through which successes are attributable to luck and which to skill may be tricky, but by firming up your investment selection process, you may improve your own luck and increase the likelihood of success. Once again, this is Miguel Gonzalez with Cortburg Retirement Advisors. Please take a moment to click the like icon and don't forget to subscribe to my YouTube channel to receive a weekly video podcast every Monday morning. Thank you for watching, and I will see you all next week.